Kristine Kubacki is the Senior Research Analyst covering industrials for Avondale Partners. Previously, she was a Senior Associate Analyst at A.G. Edwards covering the transportation and logistics industries. Before that, she worked for 6 years in operations and supply chain management at Procter & Gamble. She holds an MBA from Washington University in St. Louis. And with that, welcome, Kristine.
Everybody. Forgot my more important degree. I actually was a chemical engineer before I was lured over to the dark side of the financial markets of Wall Street. So with that, a view from Wall Street, I would say that I don't sit on Wall Street, I don't sit in New York. I could never live in New York. It's about 2 days, and then I need to see trees. So I sit in the great flyover country of St. Louis, Missouri. What are we going to talk today about? This is kind of just what we're going to talk about today. Kind of the 4 key areas, I would say, that we've already kind of touched on the macro, so I'm going to kind of fly through that to keep us on time. But obviously, the world, from our view, is that it's definitely slowing and probably the worrisome part of the equation. The U.S. industrial activity has somewhat, it's ironic, you know, in 2008 we were talking about the rest of the world, particularly China, decoupling from us, which didn't really happen, but now it's us decoupling from the rest of the world. Also, you know, in terms of the U.S., I think at the end of the year, we're all kind of wondering what's going to happen with the fiscal cliff. Then I'm going to touch on the freight flows and not just trucking, kind of broaden our view and talk about how we are viewing the U.S. economy. And then how, from a thesis perspective, how what's trucking look like to us, what is capacity doing, and then finally, near and dear to my heart, since I cover trucking equipment, I'm going to hit on that. What we worry about, and don't worry, on the top of the slide, I make fun of everybody, so I'm an equal opportunity offender, so whether you're on the other side of the Atlantic or anybody here, Republican, Democrat, you're fair game in mine. Clearly, we've already stated, you know, Europe is a mess. The one thing that does start to worry us is that the industrial activity and commodity prices have benefited from a relatively weak U.S. dollar, so seeing what that's going to do in the future might curb that activity. Obviously, the key emerging markets for us, Brazil, India, China, have been slowing, and a data point recently is you know, that excavator sales in China are off 20+%. Brazil's seeing truck sales off 40%. Obviously, there's a little bit of emission, but there's definitely a slowing trend in those countries. You know, taxes, I wonder if, in terms of the street, if we're factoring in really what the fiscal cliff looks like, and whether we have faith in our leaders to actually negotiate some sort of outcome on a lame duck session. I don't know. In terms of, you know, 4 more years, if we have a split administration and legislative branches, I'm wondering, you know, are we going to go through another round of what Obama can't get through legislatively? Obviously, we'll be at another stalemate for 4 more years, but obviously move things through the regulatory avenue. Obviously, Obama can blame the Republicans for everything. We tend to be of the nature that over the long term, while inflation has ebbed, and obviously with the U.S. dollar is strengthening, at least in the near term, but over the longer term, we do see inflation rising and continue to love hard assets. So, and the final bullet point on this slide is, you know, we are becoming a nation of explainers and not engineers anymore. I think it's indicative of kind of what's going on in Washington. You know, the stalemate, and in D.C. It seems like we're not actually making anything here anymore, and that the labor market and some of the structural trends there, we're seeing people more graduate with indebtedness, and they're graduating with communication degrees rather than engineering degrees, although I can't really say I'm not really using my engineering degree anymore. So what can we be optimistic about? We've heard a lot of negative things today. I think in terms of for access to capital, especially with corporations that have the balance sheets, they are able to access the capital markets. We've seen in some cases, Norfolk Southern, for example, issued a 100-year bond. If you have the corporate balance sheet, you're able to get the capital. And in the same vein, corporate balance sheets have been the best that they've been, and despite the severity of this recession, they are at cash levels are at very high levels. Obviously, we'd love to see them deploy and hire more people, but at this point, corporations, in terms of cash flow, earnings, profitability, is very strong despite the severity of the recession. Foreign manufacturers, there's a lot of been discussion about whether it's onshoring to North America, Mexico, but I've heard it over a theme reoccurring over the last couple conferences I've attended is that we're actually competitive from a labor standpoint with China, especially on a skill level, and then factoring in transportation costs, supply chain times. It's really been a shift, a magnitude shift since when I was at Procter & Gamble 10 years ago, where we were trying to move everything offshore. And then in terms of, I think, from the biggest generational thing that's happening, we have a real gold rush going on in Middle America in terms of the energy and everything surrounding it, from the services to the equipment that is needed, and all of that is being built here in the U.S. Moving and shifting and talking a little bit about the freight flows. It is, we follow transport stocks and transportation equipment, and it always, people say, well, Dow theory and Dow transports, they tell you what's going to happen with the economy. Well, really, those stocks are mirroring what's going on in the freight flows, and that's how we know what's going to happen with those stocks. So, looking at just the basic ones, truck tonnage is probably our favorite, at least for the U.S. economy. Obviously, it started to roll over in early 2006, and we went pretty bearish on the economy at that time. In fact, this was much before people were still sort of feeling pretty good about the U.S. economy at that point. It actually tried to stage a recovery in 2008, and then obviously when the financial markets froze, it fell concurrently. But now it's predicting that kind of modest recovery. It's nothing great. In fact, I think today the truck tonnage was reported for April. It was up 2.8% year on year. Again, that's sluggish growth, but it is growing out there. I'll touch on the intermodal rail car loadings as we're going through those charts, but export volumes have been another boom for industrial America. In terms of truck tonnage, this is truck tonnage change year on year versus GDP growth. It obviously correlates, and in fact, truck tonnage leads it by 2 to 3 quarters. So again, once 2006, we started to see truck tonnage roll over. Then we subsequently saw the rest of the economy fall over. And again, right now, it's signaling not robust growth, but sluggish growth. This is a same data. This is the absolute truck tonnage numbers, and obviously it's continuing to show a step up. What I would say is noteworthy about this, and we talk about the U.S. economy should be doing better, and we're just at trend growth. However, this is up where it is without a housing recovery, and I think that from a truck perspective, that shows that the rest of the economy, at least in the U.S., is doing pretty darn good. So what do you think about consumers? And we get asked all the time, what do you guys look at outside of freight flows in terms of what, to guide you through what you think the economy is going to do? What do you think your stocks are going to do? And everybody's, well, the consumer is not feeling well. Consumers really don't spend confidence. They don't spend how they're feeling. They may feel sad today. They may feel good next week. But they spend income. And that's where, so that's what we look more at is consumer income. And in fact, from an industrial perspective, it's more highly correlated. This is ISM, or PMI, Institute for Supply Chain Managers Index, versus truck tonnage. You can see the high correlation, because this is really what purchasing managers are sitting down today at their desk and writing POs, purchase orders for the next 2 to 3 months. It's a good indicator of the near short-term activity, and it continues. It's right now it's above 50, suggesting that the economy is expanding, and obviously we're seeing truck tonnage right along with it. There's George. In terms of, this is domestic air freight, and obviously it is stabilized. We saw the recession in 2008, and then it's rebounded, it's stabilized, it has not come back. I don't think that's necessarily a symptom of the economy here. It's more that UPS and FedEx have moved their service to the ground, and they've cannibalized some of their own market. In terms of, this is international air freight, and this has been the stalwart and the most robust freight flow. Obviously, this is really the freight flow of global trade. And every time you get I want an iPhone 5, I want an iPad 3. So every time, all the gadgetry that we're all, replacement is really driving the international trade here. I would say the one area that we're watching quite particularly in this, Asia to U.S. freight flows are still very robust. It's Europe to Asia that we're seeing, not surprisingly, the weakness in at this point. In terms of railroad car loadings, I know railroads and truckers, it's not usually a mix of it, but this data comes out every week. And more importantly, it break it out by commodity flow. Unlike in truck freight or truck tonnage, we can't see what's in the box. So from railroads, we get to see a little bit more of the inner workings of what's going on in the economy. And obviously, this chart obviously came down during the recession dramatically, and then, however, recovered. But now we're seeing the headline numbers again have been pretty ugly. Intermodal has been a tale of two types of domestic and international. International recovered somewhat from the downturn. However, domestic has been what I would call the Part 2 railroad renaissance. It's been the truck to rail to truck. It's been the longer haul piece of the trucking piece. That is up big, where international imports have continued to be down. In terms of what is driving the overall railroad car loadings to be down, this is ex-agricultural and ex-coal. And obviously you can see it's back up to near where we were before the recession. So coal has been the really big fundamental change here. This is coal volumes, weekly coal car loadings. And you can see back before the recession, a good year in coal was maybe up 2%, a bad year was down 1%. Well, then the Great Recession happened, and we took a dramatic step downward. And then in that time, also you saw the pictures on the natural gas pricing. Natural gas plummeted. We've also seen the EPA's been constricting closing older coal plants and that. But as of the last few months, though, you can see way off to the right there, we've seen another dramatic step downward. In fact, I heard today that St. Louis-based Patriot Coal might be going bankrupt. This is chemical, though, has been the offset for the railroads. Obviously, what they're not moving in coal, they're moving all the things going into the oil fields or into the natural gas. They really, truly have become the virtual pipeline. It'll be interesting to see if we get through some of the red tape, what's going to happen there with the chemical piece. But it continues to be very robust. This is obviously I said this is just the oil piece. Obviously, who says that the oil patch in Middle America is not producing? We should apply for OPEC status because this is very real in terms of what the energy activity out there. And in case you're wondering what that picture is, I'm a huge sports fan, huge blues fan, St. Louis Blues fan. I typed in Middle America into Google Images, and it brought up St. Louis Blues versus LA picture. It was the very first picture that popped up. I have no idea. I guess us versus LA, we're Middle America in St. Louis. Ag is no special story there. It's been down, obviously the droughts last year, but it's been relatively stable and held in there. This is a surprising market is the metals. This is something about industrials, both chemicals and metals, is very strong, whether it's automotive, but automotive enough doesn't explain the strength in the recovery in metals, whether it's export, but it may be all the things we're assembling here in the U.S. And so this is probably the picture here that makes me, I get a little bit worried about the rest of the world, but right here, this continuing to hold up week on week data is what keeps me from feeling that before we go hiding under my desk. This is basically sands and some construction activity. This is showing the activity around fracking and like I said, moving some of the commercial construction related goods. This is automotive, and I think this is an interesting chart because I hear all the discussion about automotive has rebounded, but we are still really low below the levels of where we were. So these are our automotive car loadings, but obviously well off the bottom in terms of U.S. car shipments. Housing is a different story. This is definitely an ugly chart. This is lumber car loads. It has come off the bottom a little bit, and I hear there's a lot of euphoria that we are seeing a recovering in housing market. We've seen some statistics where the number of housing starts, and whether that's the weather, I don't know. But this chart, in terms of the actual goods that are moving or the actual lumber that's going to build the housing, and we do still make houses out of wood, it's not showing up in the lumber car load data just yet. So talking a little bit about the capacity side of the equation for trucking and trying to think about what the thesis is, what's going to happen to pricing, we've talked about the freight piece. This is truck driver pay versus unemployment, which is unemployment rate, which has been a great predictor. As driver pay has gone up traditionally in the past, we've seen unemployment fall. And right now we're seeing, obviously, as everybody was talking about, the finding drivers is a critical situation. I'm wondering, though, how the move upward in driver pay recently, though, has been more because of the regulatory changes, and so it might forecast, a slower drop in unemployment at this point. We are the firm that, this is failure data, so this is trucking failure data. My colleague Donald Broughton, who's the transportation analyst at Avondale Partners, is the provider to the industry for trucking failure data, so I'll cite him. And as you can see, this is versus fuel, and I think that something is interesting. Obviously, we've seen fuel spike up, and in the past, in the past 2 cycles, we would have expected where fuel got to, we would have seen the rush of failures. Well, that just hasn't happened. Our thought is that, you know, if you've made it this far, you're here. And so, and the number of trucks that are going out of the market, and perhaps the other reason being is if we're seeing more vulture acquisitions, that those trucks are never hitting or we're never filing bankruptcy at this point, even where fuel is. So in terms of, in terms of capacity, you've got drivers, obviously failures. I think drivers is the biggest constriction to capacity. The offset to that, though, is that has been, and we saw this last year, and we were seeing it again, as I said, that the railroad renaissance has been in the domestic intermodal side. The swing gate on capacity has been through the railroads at this point. So this is long-haul trucking. While it has popped up recently, it hasn't correlated as well, but there has been a slow demise as the truckers, as they've moved stuff into the railroad. So the market has definitely shrunk on the long-haul side. If you don't get this joke, see me at the cocktail hour, and I'll maybe explain it to you at that point. This is, I'm going to skip this slide since I know we're in time. The government is one of the, talking about capacity, is actually a positive in terms of constriction to capacity. I know before I say that. There's a host of all of these rules on here, and what it really is directing barriers of entry to the market. Although in terms of what it's also doing is on my equipment side, and I know all of you see it with your pocketbooks, it's driving equipment costs upward, it's driving the cost of doing business upward, but it's also at the same time constricting capacity. Just to move on the equipment cycle, something near and dear to my heart, that's Ice Road Truckers. It drives my husband crazy. I am the only woman that watches that show every week. It's on my DVR. While my other friends are talking about The Voice and American Idol, I watch Ice Road Truckers. But anyway, talking about the equipment cycle, it really has, generally, as we viewed it from Wall Street, why do you buy a truck? To move freight. Really, this cycle, we've seen some changes. It's almost decoupled. The freight has decoupled from the equipment cycle at this point. I think some of it is obviously due to the EPA, and we've seen a lot of shifts in every emission cycle has driven a pre-buy. And in fact, in 2011, the fact that bonus depreciation pulled forward, and we had another mini pre-buy in 2011. The access to capital remains tough out there, especially for less well-capitalized fleets. The cost of equipment, obviously we saw that quote earlier, it's becoming harder to justify. I think the interesting thing here is that the OEMs have ramped up to meet production at the fourth quarter level, which is where we saw a lot of the bonus depreciation driven demand. However, they have continued to produce at that rate at 315,000 units. And so if the order rates continue, we're going to have to see production cuts in the second half of the year. Would comment on the natural gas. I know there's been a lot of buzz here today. I was actually out at the Alternative Clean Transportation Conference last week for 3 days in Long Beach, and I heard a lot about it. It seemed like it was in its infancy. I walked away with a lot of questions still, but I would tell you, and I heard the proverbial chicken and egg more than I wanted to. But it really sounds like over the next 18 months, in terms of distribution and in terms of the equipment offerings, we're really going to see this industry go from more of a linear to exponential kinds of growth. So in terms of equipment side, this is orders, this is month-on-month orders, the red bars being the 2012, black bars being 2011, and obviously you can see the effects of bonus depreciation demand. So it's really been surprising to us that we have seen the weakness, especially in the seasonally stronger period of the year of when we should be seeing those orders. In terms of this is kind of the order, the green being the most recent cycle, and you can see the red check line is the last cycle, and you see 2005, 2006, that emissions peak there. And it seems that in terms of driving the order demand, we're going to have to see something economic. If we're going to see a big year or see that 315,000 kind of year, obviously we're going to need something in terms of either freight growth, or we're going to need to see something, some sort of, economic, another bonus depreciation. There is still a little bit of one this year, 50%. I just don't know if that's going to be enough to push the buyers off the fence. At this point, people we talk to keep continuing to say, and we heard this, this theme, is it's really about uncertainty. It's uncertainty about drivers. It's uncertainty about the economy. It's uncertainty about my costs. It's uncertainty about the equipment and the emissions technology out there. So it's really about uncertainty, and it's either going to be economic or it's going to be we lessen the amount of uncertainty out there, and I'm not quite sure how it's going to play out. So this is the North American Class 8 inventory versus retail sales. Worrisome is the magnitude jump up. Again, OEMs are continuing to produce. We're not seeing retail sales follow through, and we're seeing the inventory go up. So I would all encourage you as an equipment analyst to go out and talk to your dealer and buy some trucks. This is just our view on the trucking cycle. Again, we believe it's going to be a little bit more flat this year. We're differentiated in that view versus the rest of the street, at least, is that it may grow 5 to 10% this year, but it's not going to be upwards of what I know some of the other research houses are calling for, upwards of 275 to 300. So in terms of predictions, we're all feeling after having an hour of economics, so I thought I'd switch course here a little bit. My favorite show on Sunday mornings, I mentioned I was a sports fan, is the Sunday Reporters. It's John Saunders on ESPN. And these guys get to sit around on these big comfy couches and make predictions, and then nobody actually comes back, and you don't have to have any data to back it up. They don't put anything out there. My clients, when I make a stock call, they come back to let me know when I made a wrong one. They don't really call me when I make the right one. That was their idea. So I just thought I'd throw these out here real quick, and you can come find me if you want to talk about these some more, so I feel pretty good about it. I think the Cubs will not win a World Series in my lifetime. The St. Louis Blues will win the Cup in 2013. It was a total fluke by LA. Tim Tebow mania will continue. Denver will win the Super Bowl with Peyton Manning, and the Rams will move to LA in 2015. They can have them. Tiger Woods will not win another major. I'm feeling pretty good about that one. And then here in Alabama, I would tell you that I am the only house in the city of St. Louis that has an Auburn flag hanging outside of it. So War Eagle. Thank you for your attention.